Here's a number that should annoy you. A fee difference of less than 1% a year can cost you tens of thousands of dollars over your investing lifetime. Not because the fee itself is huge, because it compounds, the same way your returns do, except working against you instead of for you. Nobody explains fees this way. They get buried in a fun fact sheet as a small percentage, and small percentages don't feel dangerous. 0.2%, 1%. Who cares, right? Here's why you should. Let's run the actual math. Say you invest 10,000 euros and leave it for 30 years, and say, purely as an illustration, not a promise, your investments grow at 7% a year before fees. That's a common long-run assumption for a diversified stock portfolio, not a guarantee of what will happen to your money. At a fee of 0.2% a year, your 10,000 euros grows to just under 72,000 euros after 30 years. At a fee of 1% a year, which sounds small, which sounds like nothing, that same 10,000 euros only grows to about 57,000 euros. Same starting amount, same assumed market return. The only difference is a fee gap of 0.8%, and that difference cost you around 14,500 euros. Not because the market did anything different, because the fee compounded every single year, quietly eating a slightly bigger bite each time your balance grew. Now stretch that to someone actually building wealth over time, investing 500 euros a month for 30 years, same assumptions. At the low fee, you end up with around 586,000 euros. At the higher fee, around 502,000 euros. That's an 84,000 euro gap. From a fee difference most people wouldn't even notice on a fact sheet. So where do these fees actually show up? Every fund, every ETF, every mutual fund charges what's called an expense ratio, sometimes labeled TER, total expense ratio, or OCF, ongoing charges figure. It's the annual cost of running the fund, taken directly out of your returns before you ever see them. You don't get a bill. You just quietly earn less than the market actually did. Here's the part that should really bother you. Fees are one of the only things in investing that actually predict future performance. Not stock picks, not fund manager reputation. Fees. Morningstar's Director of Manager Research, Russel Kinnel, ran a study tracking fund performance by expense ratio over a 5-year period. The cheapest quintile of U.S. equity funds had a 62% success rate, meaning they survived and beat their category. The most expensive quintile had a 20% success rate. The cheapest funds were 3 times as likely to actually deliver. Think about what that means. In an industry obsessed with predicting the future, which stock will outperform, which manager has the golden touch, the one number that has actually held up as a predictor isn't a forecast at all. It's just the fee you're being charged. And fees have come down a lot, industry-wide, which is genuinely good news. According to the Investment Company Institute, the average equity mutual fund charged just over 1% a year, back in 1996. By 2025, that average had fallen to 0.4%. Index-based equity ETFs now average around 0.14%. So the direction is right. But average is doing a lot of work in that sentence, because plenty of funds still charge well above average, and a lot of investors are in them without realizing it. Take a fund like VWCE, the Vanguard FTSE All-World ETF, a genuinely popular global tracker. Its total expense ratio sits around 0.2%, give or take, depending on which source you check. Compare that to a typical actively managed global equity fund, which can easily sit at 1% or more. On paper, that's a difference of less than 1 percentage point. In practice, over decades, it's the $84,000 gap we just walked through. Here's the trap. High fees don't announce themselves as a bad deal. Nobody markets a fund by saying, "Pay us more for probably worse results." Higher fee funds get sold on the story, the manager's track record, the strategy, the promise of beating the market. And sometimes, in any given year, they do. But zoom out to a 5, 10, 20-year horizon, and the fee is one of the few variables that behaves predictably. It doesn't need the market to cooperate. It gets paid whether the fund goes up or down. Quick pause here. If this is the kind of thing you want broken down before you make the decision instead of after, that's what this channel does. Subscribing means the next one lands in front of you instead of you having to go looking for it. So what do you actually do with this? First, know your number. Every fund has a published expense ratio. It's not hidden, it's just easy to skip past. If you don't know what you're paying, that's the first thing to check today in whatever platform you invest through. Second, understand that a low-fee index fund isn't a compromise, a good enough option next to something better. Given how strongly fees predict outcomes, low cost is one of the closest things investing has to a genuine edge. Third, when you compare two similar funds, don't just look at the story. Look at the number next to expense ratio, and remember that the gap between 0.2 and 1% isn't a rounding error. It's a decades-long tax on your own money, one that compounds exactly like your gains do, just in the wrong direction. The market doesn't care whether you pick the exciting fund or the boring one. It pays the same return to both before fees. What happens after that split is almost entirely about what you agreed to pay to hold the thing in the first place.